Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His websites, PIFinancial.com and PolarFuturesGroup.com. Welcome back to the show, Drew.
Thanks for having me on, Jim.
Drew, the U.S. dollar has been softening over the past month, but finally some stronger bids have driven it higher. What's the driving behind the U.S. dollar right now?
Well, this Wednesday we had another Federal Reserve meeting where the Fed raised rates a quarter of a percentage point. They seem like they want to continue to hike rates. We've got, the labor market in the United States, very strong unemployment rates at, near all-time lows, that sort of thing. So we're starting to see some wage pressures. So the Fed moving forward and sounding like they want to continue to move forward, and by that I mean they're pricing in another rate hike for December of this year and penciling in another 3 rate hikes for next year. So interest rates moving higher in the U.S. will continue to drive interest rate differentials in the U.S. dollar's favor, even though we do have, Europe and the ECB starting to move towards tightening. The U.S. is definitely, moving at a faster clip and already raising rates, where the ECB is more in a phase of pulling back some of the accommodation that's there. And then the other big move towards the end of this week has been, Italy coming back to the boil. So I had thought, as we had the initial flare up back in May around Italy, it kind of cooled off, and then we had some emerging market issues going on about a month or so ago. And now Italy, having to put forward a budget for their government, is, coming back to the forefront as their government wants to spend more fiscally. So today alone, we saw the 2-year Italian yields jump up more than 30 basis points. They're back over 1%. Just a reminder for listeners that before May, before that initial move, the Italian 2-year was at negative 30 basis points. So you would give the Italian government money and they'd give you less back.
If the U.S. rate differentials were going to be a key driver again, where do you see U.S. rates going?
Well, I think they are a key driver. I think you have to look at the fact that the 2-year against U.S. against Germany is over 335 basis points. That's at all-time records. So if we see that continuing to, push the U.S. dollar higher, and we're going to see the Fed continue to move higher, I think, the U.S. 10-year, to use that as a benchmark, can move much higher. I mean, we've been stuck above 3% on the U.S. 10-year for the last week or so, and there hasn't been the big fanfare that we got the first time we came here, and we've been at a high, or had a high of about 3.11 or 1.2 on the U.S. 10-year. I think it's very likely that we push through that in the near term. And then it's just a matter of sort of looking back at some of the technical highs. I mean, 3.25 is very reachable in the short term, and that puts the U.S. 10-year at a 7-year high. And then the bigger benchmark going forward from there is 4%, and that would be a 10-year high on the U.S. 10-year mark as well. So I think both of those are going to be key levels to watch. I do think the 3.25 level will get to very soon. 4% obviously a little bit of a bigger move, but it is my view that the Fed will continue to raise rates, and as much as the market thinks they may go a little bit more gradually, they're a little worried about where the neutral rate is, and they want to get to that and maybe exceed that a little bit. I think that the market will keep moving rates higher. And the other thing is that as Trump continues to move forward with these trade wars or tariffs, however you want to look at it, he doesn't seem to be backing down. He's going to be, engaging Japan in more trade talks to try and get them to do something about the number of autos that they have coming into the U.S. So I think you have to look at these tariffs as being inflationary. And if you're a mandated central bank, like our Bank of Canada here is mandated on inflation, the U.S. Fed is on employment and price stability, so employment and inflation, and employment is full, and inflation is, at their target, and if we start to see inflation run up, they really will have to act, and maybe act even more frequently or quicker than the market is pricing in, and again, that will see rates moving higher. So I think U.S. rates still have a little ways to go. I think it will ultimately be this hiking cycle that puts a damper on the economy, but I don't think we're there yet. I think there's more to run in that. So I think, as we go into next year, the 4% target is a very attainable one on the U.S. 10-year.
We'll have more with Drew Zimmerman right after the break.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, Canada is expected to raise rates in October, especially after Polis's speech yesterday and the GDP numbers that came out today. Will this narrow the interest rate differential with the Canadian dollar?
The U.S.-Canada interest rate differential has been around 60 basis points. We're at that level now. It had been a little deeper, so the good news in the past little while has helped that come back. But again, I think, even if we do get the rate hike in October that is fully priced in at this point, the Fed is still going to be moving faster than the Bank of Canada. So we had a Fed move this Wednesday. I think they're going to move again on December. The market is pricing that in. And then the Fed will move more quickly than the Bank of Canada through 2019 as well. So I see more pressure on that interest rate differential as we go forward. I think the Bank of Canada does want to move in the same direction as the Fed is, but they're just not going to be able to move at the same pace. We hear Polas talk about he knows that each interest rate hike in Canada affects Canadians more than it has at any time in the past because of the amount of debt Canadians hold, and especially the amount of real estate debt that Canadians hold, and what a big part of the Canadian economy that real estate segment has become. So if that starts to slow more because of interest rate hikes, not only does that affect, the people that are paying their mortgages or paying other debt instruments, but it also affects the employment of everybody that's in the real estate market if real estate starts to slow more than it is already. So they'll be watching that, and I think taking a very cautious approach going forward. And then, of course, there's other issues for Polas to worry about as well, being NAFTA. The trade issue seems to just, get carried on longer and longer than everybody thinks it will. We don't seem to get any resolution to that. So another deadline looking like it may come and go this weekend with nothing getting done. It is going to continue to be a wait and sort of a reason for the Bank of Canada to remain cautious. So just another reason why they're going to be moving slower than the Fed down in the U.S.
So given that, where do you see the Canadian dollar going?
Well, near term, the Canadian dollar has held up relatively well, I would say. I feel like the market wants to be optimistic about the trade deal. So as much as interest rate differentials are always key, there's always other components that are driving it at any given time, and the trade talks are definitely a big part of that. I still think there's a lot of, room to be pessimistic about the trade deals. Even if it gets done right away, we don't know what it's going to look like, what concessions will be given. The market, I think, is pricing in a much more optimistic approach. I mean, Canada's at about 77.5 cents right now. That's near the highest end of the range we've been in over the last several months. The, sort of tough, or not tough talk, but hawkish talk out of poll laws last night, and then the slightly better GDP print this morning, again moving Canada back higher. But I think if we're in Canada fighting a stronger U.S. dollar because of what we talked about earlier, and Canada has the trade issues to worry about, let alone the pipeline issues and the huge oil differential that we're getting for our crude in Western Canada. It's out over a $35 discount to WTI. So I think the price increase of crude oil generally, that's WTI trading above $73, helps Canada in a broad sense, but at the same time, we can't get our oil out of Canada at a decent price, so that's hurting us more than the headline oil number is helping us, so to speak. So I'm concerned that Canada could have a bit of what I'm calling a trap door trade ahead, where it almost stays high on a wall of worry of what's going on with it, and all of these things that are sort of building up beneath the surface just happen all at once, and we could see a very sharp drop in the Canadian dollar if we weren't to get a resolution in NAFTA. And if that were to come with auto tariffs being put on Canada, I think you really have to start pricing in the Bank of Canada, not only not raising rates near term, but looking at the possibility of even cutting rates. And that really isn't on people's radar right now. So I think we're in a bit of a asymmetrical risk scenario with Canada right now. If NAFTA was to get signed, yes, near term, that's a good benefit, and I'm sure we'd get a relief rally on that. I don't know that would run more than a penny or penny and a half. I think if the negative scenario came out, Canada could easily be down to 72 cents within a couple of months.
We'll have more with Drew Zimmerman right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, what's your view on gold given your outlook for interest rates in the U.S. dollar?
Yeah, as we talked about interest rates earlier in the show, I mean, I look at gold mostly in the scope of having, two key elements determining the price. One is the U.S. dollar, and the other is real interest rates, so not just the nominal interest rates that we see in the headlines. But with the Fed raising rates on Wednesday, we had short-term rates moved into positive real territory for the first time in pretty well a decade. So having real rates move higher is going to be a negative for gold because you can get more interest when real interest as nominal rates are going up faster than inflation. So that's going to be a headwind for gold as we go forward. But more importantly, I've really been looking at the strong negative correlation between the U.S. dollar and gold. It's been incredibly tight over the last couple of years, and especially in the last year. And the only time that it really weakened over that time has been the last month or so, and that was when the U.S. dollar softened. So when the U.S. dollar softened, we should have seen gold really be able to pull out a much better rally than it did. If anything, it just sort of consolidated on the lows of where it had been trading. So when we traded down to 1180 and then came back to 1220, we stayed in a pretty tight range. And with a little bit of U.S. dollar strength again, we see gold trading right back down towards that 1180 low. Well, the U.S. dollar isn't getting back to its recent high. So I think if we see the U.S. dollar move back towards the 95, 97 range on the dollar index, you're going to see that renewed pressure push gold to new lows. And once gold starts making new lows again, we could see more selling come into it. So I'm looking at some longer-term support levels of the 1130 level. And again, if we see the stronger U.S. dollar scenario play out that I think we could, then I think you really have to look at the 1050 low in gold. So the U.S. dollar really not helping gold here. Real rates still not helping. But I think, if we get pushed down to those levels, say in the next several months, 6 months, 8 months, then you really need to be keeping an eye on inflation. I think when inflation starts moving faster than nominal rates, that's where you can get sort of a multi-year tailwind going for gold as real rates start heading lower and gold could start heading higher, and possibly even an environment while the U.S. dollar is still going higher. So that's what I'm looking for in gold. But near term, really watching that strong negative correlation with the U.S. dollar, really looking like it's going to push gold to new lows. So that's what I'm looking out for.
Drew, thank you so much for chatting with us.
Well, thanks for having me on again, Jim.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His websites, pifinancial.com and polarfuturesgroup.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.